A cash ledger is used to track movements of cash in and out of your business so that you know your cash balance. In the example on the screen, the first line of the ledger shows the starting balance for the month. The sale to the customer is a cash-in transaction, and the amount is added to the balance on the previous line to obtain the current balance. The payment to Farmer 028 and the purchase of petrol are cash-out transactions. Each amount is subtracted from the balance on the previous line to obtain the current balance. This slide shows a single ledger for the purpose of demonstrating how a cash ledger works. For training purposes, we will not focus on whether these transactions are by bank or cash on hand. Let's discuss the columns in the cash ledger in more detail. Column 1 shows the date the transaction occurred. This is not the date that you updated the cash ledger. In your cash ledger, you may add a column to indicate the date that the entry was made into the cash ledger. Column 2 shows the source ledger for the transaction. Although some businesses only maintain a single cash ledger, as your operations expand, it may become more practical to keep separate expense and sales ledgers as well. These ledgers are the source of transactional data and feed the cash ledger so you can track your business's cash balance. When you use multiple ledgers, you will enter details of each monetary transaction into two ledgers. Although at first this may seem like you are recording each transaction twice, the cash ledger entries and the records of cash transactions have very different purposes. This example shows that the sources of the cash transactions are the sales, farmer, and expense ledgers. Column 3 shows a description of the transaction. This information is taken from the source ledger. It will likely include less detail than what has been entered into the source ledger. Columns 4 and 5 indicate the value of the transaction. If cash flowed into the business as a result of this transaction, the total value of the transaction is entered in column 4. If cash flowed out of the business as a result of this transaction, the total value of the transaction is entered in column 5. Column 6 shows the cash balance after each transaction is recorded. The starting balance on the first row is the ending balance from the previous month. This amount should have been confirmed, or reconciled, against your bank statement or physical count of petty cash. Any difference should have been resolved before the end of the previous month. The value of cash-in transactions are added to the balance from the previous row. The value of a cash-out transaction is subtracted from the previous balance. The balance in your cash ledger must match your actual cash on hand and/or in your bank account. Assuming that the last transaction for the month of August 2020 was the purchase of petrol on August 20, what would the final cash balance be for the month? This amount is calculated by taking 179,500,000 minus 30,000 for a final cash balance of 179,470,000. In this example, the payment to Farmer 028 occurred after the sales transaction. If the payment had occurred before the sales transaction, the business would have experienced an overdraft. An overdraft results in a negative cash balance. If this happens, contact your bank to alert them of the overdraft and inform them that you are expecting a payment. By updating your cash ledger, you will know your cash balance. On a daily basis, you must ensure that the number you have in your books matches your bank balance and physical cash on hand. If you have access to your bank account online, check it daily. If you do not have access to your bank account online, check regularly with your bank to confirm your balance. Also, count physical cash each day to confirm the balance. At the end of each day, your cash ledger balance must match the sum of your physical cash plus your cash in banks. This is one of the most important tasks in the financial management of a business. If you do not have a match, you need to investigate and resolve the discrepancy. A mismatch is often the result of human error in recording transactions, but it could also indicate a more serious problem such as theft. One way to help prevent problems with cash is to implement cash controls in your business.